Are you interested in finding strategies to boost your current income? It's possible that peer-to-peer lending, often known as peer-to-peer lending, could be a viable choice for you. Individuals can engage in peer-to-peer lending through an online marketplace, which enables them to lend and borrow money directly from one another. Platforms that facilitate peer-to-peer lending play the role of middlemen, connecting borrowers and lenders. You can get a return on your investment by acting as a lender and investing your money in a diversified portfolio of different loans. When compared to more conventional investment vehicles, such as savings accounts or certificates of deposit, peer-to-peer lending may provide for more lucrative returns. It is essential to have an awareness that peer-to-peer lending, like any other type of investing, is subject to certain dangers. It is critical to have a diversified investing portfolio and to have a solid understanding of the risks involved. Peer-to-peer lending, on the other hand, presents the opportunity for possibly larger returns if you take the time to select your assets thoughtfully and effectively manage your portfolio. Peer-to-peer marketplaces have mechanisms in place to assist with this situation, like buyback guarantees and payment guarantees. Some peer-to-peer lending platforms provide investors with various forms of security, including payment guarantees and buyback guarantees, among other sorts of protection. These guarantees may assist in reducing the risk of default by borrowers, which is a significant worry for those who invest in peer-to-peer lending. A pledge provided by the peer-to-peer lending platform to cover any missing payments made by the borrower is referred to as a payment guarantee. For instance, if a borrower fails to make a payment on a loan, the platform that facilitates peer-to-peer lending may step in and make the payment on behalf of the borrower, either by using its own funds or by resorting to some other method. This helps to protect the return on investment for the investor and also makes it more likely that the investor will get the payments that were anticipated for the loan. The commitment given by the platform that facilitates peer-to-peer lending to repurchase a loan from an investor in the event that the loan is not repaid by the borrower is known as a buyback guarantee. For instance, if a borrower misses a payment and the loan falls into default, the platform for peer-to-peer lending may buy the loan back from the investor at the initial investment amount plus any interest that has accrued since the loan was made. Instead of having their money go to waste owing to default, investors can now get their money back thanks to this provision. It is essential to keep in mind that not all peer-to-peer lending platforms provide payment guarantees or buyback guarantees, and the terms of these guarantees can differ depending on the platform. Before putting their money into a peer-to-peer lending network, prospective investors need to make sure they have a thorough understanding of the platform's assurances, including the associated risks and limits. Consequently, here are some more suggestions for achieving achievement. Increase your portfolio's diversity, spread your money out across a number of different loans to lower the overall level of risk. Do your research on the borrowers. Thoroughly examine the borrower's credit history as well as their financial facts, so that you can make educated investment judgments. Check out sites like P2Pempire.com for a review on platforms. Make use of automatic reinvestment. In order to maintain the growth of your portfolio, you should establish automatic reinvestment. Also, speaking from my own experience, try not to be too greedy. Although there are loans available with high rates of return, in my opinion it is not prudent to take on such a venture given the potential downsides. A loan that has an interest rate of 10 to 12%, a short duration of a few months, and either a buyback guarantee or a payment guarantee is, in my opinion, an investment that is relatively risk-free. You may wish to consider applying leverage with a bullet loan rather than selecting loans that have higher interest rates. A bullet loan is a form of loan that requires the borrower to make a single, large repayment at the conclusion of the loan period rather than multiple, smaller payments. When compared to a standard loan, which often needs the borrower to make consistent payments, such as monthly payments, over the life of the loan term, This alternative does not require the borrower to make payments on a regular basis. Leveraging your existing cash and perhaps increasing your returns can be accomplished by using a bullet loan to finance investments in peer-to-peer lending platforms. It is essential, however, to be aware that peer-to-peer lending is fraught with dangers such as the possibility of borrowers not paying back their loans. It is possible that you will not receive the entire return on your investment if the borrower of the peer-to-peer loan in which you have invested goes into default. This may have an effect on your capacity to repay the bullet loan. You should also be aware that the terms of a bullet loan may or may not correspond with the terms of the peer-to-peer loans in which you are investing. You might be required to repay the loan, for instance, if the duration of the bullet loan is shorter than that of the peer-to-peer loans. This would mean that you wouldn't have gotten all of the anticipated profits from the peer-to-peer investments. Because of this, it is possible that you will be forced to sell your peer-to-peer investments before they have reached their full maturity, which could result in you incurring losses on those assets. Because of this, it is in your best interest to have a shorter term for your peer-to-peer loans in comparison to the term of your financing. Let's explain this with an example by imagining that you have a portfolio that consists of a total of €30,000, and that your average return is approximately 10%. Now, let's say that €100,000 of that portfolio consists of equity, and another €200,000 of that portfolio comes from loans at a 5% interest rate. That indicates that you are generating a profit of €30,000 per year from your portfolio, while devoting €10,000 to the bank as interest payments. This nets you €20,000 instead of the €10,000. Now you might say that you don't have €100,000 to invest, but there are ways to raise money, but that's a topic for another video. If you liked the video, don't forget to like, share and subscribe.